Hi, my name is Suhatina. I'm from wasidi.com and I'm here today to help you mastering in accounting. And today's topic is about step in recording process. So let's check this out this video. In order to have a comprehend understanding, first we will talk about the basic step in the recording process. In practically business today, there are three basic steps in the recording process. There are analyze each transaction for its effect on the account, enter the transaction information in a journal, and the last is transfer the journal information to the appropriate accounts in the ledger. Although it's possible to enter the transaction information directly into the account without using journal, few businesses do so. The recording process begins with the transaction. Business documents such as a sales slip, a check, a bill, or a cash register tape provide evidence of the transaction. The company analyzes the evidence to determine the transaction effect on a specific account. The company then enters the transaction in the journal. Finally, it transfers the journal entry to the designated accounts in the ledger. The step in the recording process occur repeatedly. Second, what is a journal and how it helps in the recording process? Companies initially record transactions in chronological order. Thus, the journal is referred to as the book of original entry. For each transaction, the journal shows the debits and the credits effect on a specific account. The journal makes several significant contributions to the recording process. First, it discloses in one place the complete effects of a transaction. Second, it provides a chronological record of transaction. And third, it helps to prevent or locate error because the debits and credits amount for each entry can be easily compared. Journalizing. Entering the transaction data in the journal is known as journalizing. Companies make separate journal entries for each transaction. A complete entry consists of the date of the transaction, the accounts and the amount to be debited and credited, and the third is a brief explanation of the transaction. Let's see the example. Illustration shows the technique of journalizing using the first two transactions of a company. On September 1, shareholders invested about $15,000 cash in the corporation in exchange for ordinary shares. And the company purchased computer equipment for about $7,000 cash. The number G1 indicates that the company recorded these two entries on the first page of the General Journal. The date of the transaction is entered in the date column. The debit account title, that is the account to be debited, is entered first at the extreme left margin of the column headed Account Titles and Explanation. And the amount of the debit is recorded in debit column. The credit account title, that is the account to be credited, is indented and entered on the next line in the column headed Account Titles and Explanation. And the amount of the credit is recorded in the credit column. A brief explanation of the transactions appears on the line below the credit account title. A space is left between journal entries. The blank space separates individual journal entries and makes the entire journal easier to read. The column titled Ref, which stands for reference. It is left blank when the journal entry is made. The column is used later when the journal entries are transferred to the ledger account. Please keep in mind, it's important to use correct and specific account titles in journalizing. The main criterion is that each title must appropriately describe the content of the account. Some entries involve only two accounts, one debit and one credit. Let's see this illustration. An entry like this is considered a simple entry. Some transactions, however, require more than two accounts in journalizing. An entry that requires three or more accounts is compound entry. To illustrate, assume that on July 1, Butler Company purchased a delivery truck costing for about $14,000. It pays $8,000 cash now and agrees to pay the remaining $6,000 on account. That means to be paid later. The compound of entry is as follows. The third discussion tells about what is a ledger and how it helps in the recording process. The entire group of accounts maintained by a company is the ledger. The ledger keeps in one place all the information about change in specific account balance. A general ledger contains all the assets, liabilities, and equity accounts, as shown in illustration below. The ledger provides the balance in a various accounts. For example, the cash account shows the amount of cash available to meet current obligation. Account receivable shows amount due from customer. Account payable shows amount owed to creditors. Each account is numbered for easier identification. However, in a practice, the account forms used in the ledger are much more structured. This is the illustration. This is called the three-column form of account. It has three money columns: debits, credits, and balance. The balance in account is determined after each transaction. Companies use the explanation space and reference columns to provide special information about the transaction. Next is about chart of account. The number and type of account differ for each company. The number of account depends on the amount of detail management desired. For example, the management of one company may want a single account for all type of utility expense. Another may keep separate expense account for each type of utility, such as gas, electricity, and water. Most of a company have a chart of account. This chart lists the account and the account numbers that identify their location in the ledger. The numbering system that identifies the account usually starts with the statement of financial position account and follows with the income statement of account. The range of the account numbers are as follows. Account 101 until 199 indicate the asset account. 200 until 299 indicate liabilities. 300 until 399 indicate equity account. 400 until 499 indicate revenues. 500 until 799 indicate expense. 800 until 899 indicate the other revenues. And then 900 until 999 indicate the other expense. This illustration shows the chart of account sample for a Pioneer Advertising Agency Incorporation. Account that shown in the red one is account that we use in this section. The fourth discussion is about what is posting and how it helps in the recording process. Transferring journal entries to the ledger account is called posting. Disposal of the recording process accumulates the effect of journalized transaction into the individual account. The posting involves the following steps. In the ledger, enter in the appropriate columns of the account's debit, the date, journal page, and the debit amount that's shown in the journal. In the reference column of the journal, write the account number to which the debit amount was posted. In the ledger, enter in the appropriate columns of the account's credit, the date, journal page, and credit amount that's shown in the journal. In the reference, write the account number to which the credit amount was posted. The fifth discussion will discuss about preparing a trial balance and what is purpose of the trial balance. A trial balance is a list of accounts and their balance at a given time. Customarily, companies prepare a trial balance at the end of an accounting period. They list accounts in the order in which they appear in the ledger. Debit balance appear in the left columns and credit balance in the right columns. The primary purpose of a trial balance is to prove or check that the debit is equal with the credits after the posting process. The sum of the debit balance in the trial balance should equals the sum of the credit balance. If the debits and credits do not agree, the company can use the trial balance to uncover errors in journalizing and posting. The steps for preparing a trial balance are: first, list the account titles and their balance. Second, total the debit and credit columns. The third, or the last, is prove the equality of the two columns. This illustration shows the trial balance prepared from Pioneer Advertising Agency Incorporation ledger. Note that the total debits is for about $28,700. That is equal with the total credits that is for about $28,700 too. A trial balance is necessary checkpoint for uncovering certain types of error before you proceed to the other step of the accounting process. For example, if only the debit portion of a journal entry has been posted, the trial balance would bring this error into the light. However, trial balance has limitation in the recording. Numerous errors may exist even though the trial balance columns are correct. For example, the trial balance may balance even when a transaction is not journalized, a correct journal entry is not posted, a journal entry is posted twice, incorrect accounts are used in journalizing or posting, or offsetting errors are made in the recording in amount of the transaction. The trial balance does not prove that the company has recorded all the transactions correct or that ledger is correct. Finally, this is the end of this section about step in recording process. Thank you for watching this video and don't forget to like and subscribe this video and see you in the next session. Bye bye.